Hello friends, welcome back to the next session of General Insurance. Now let's begin with our learning. In this particular session, we'll be dealing with and understanding the concept of profit commission. In terms of profit commission, the learnings or takeaways from this particular session will be how do we describe reinsurance, what do we mean by the concept of profit commission, and why it is necessary or important for a profit commission to be into existence. Now let's start our learning. Reinsurance, as we have seen earlier, or in the current slide, you can see the definition as reinsurance is insurance for an insurance company, wherein a company which has been registered or which has been conducting the insurance business for an insured person, what does he do? He takes an insurance contract on behalf of a certain person. Now, this particular insurance company, in order to mitigate or in order to reduce the risk of loss for the self-organization, it gets again reinsured. So the reinsured contract is being signed between an insurance company and some another insurance company, and such contract is called as a reinsurance contract. So the risk of loss that is going to be occurred over a period of time is tried to be minimized, or it is tried to be reduced, and accordingly the risk of loss is being shared between the two companies. So initially we have the primary insurance holder, second we have the insurer company, and third we have the reinsurance company. So in this way, the concept of reinsurance is the insurance for insurance companies. Now let's look at the various parties that have been involved in the reinsurance contract. In terms of the reinsurance contract, we have three types of parties, or three parties have been involved in reinsurance contract. The first party is the person who is insured, that is the insured person, the primary policy holder. The second is the insurer, that is the insurance company who has taken the insurance contract. The third party is the reinsurance company, wherein the reinsurance company has taken the insurance contract from the reinsurance company. In this particular case of a reinsurance contract, the reinsurance company is called as a cedent, whereas the reinsurer company is called as a ceded. So in this way, there are various parties that have been involved, and accordingly the reinsurance contract is into existence. Now, what is the importance or need of profit in terms of a reinsurance contract? Always, whenever we say that an amount or a particular transaction is being undertaken, at every stage, everyone is looking for a certain amount of earning. And that particular amount of earning that we are looking for, or an individual company or a businessman is looking for, is an amount of profit. So this particular amount of profit involves a amount of sharing. So sharing of profit between the insurance company and reinsurance company is essentially required. And how is this particular profit shared from? This particular profit that has been generated, or it has been created or earned, it has been created or it has been earned with the help of or from the amount of premium that has been paid by the insured person to the insurance company. So initially, when the contract is been taken by the insured person from the insurance company for this particular concern, he pays a certain amount of premium. In other words, or in return, the insurance company, when it takes an insurance contract from the insurance company to the reinsurance company, they again have to pay a certain amount of premium, and hence from the amount of premium that is paid by the either insured person or by the insurance company, the amount of profit is being shared. Transfer of risk or loss. Profit commission or profit remuneration is essentially important because it is being transferred from one person to another person or one company to another company. That is, we are transferring the risk. Initially, the risk has been transferred by the insured person to the insurance company, and in the second case, the risk has been transferred from the insurance company to the reinsurance company. So here, always there is a sharing of transfer of risk or loss that is going to be occurred, or which is going to be suffered by the different parties. The reinsurance contract is profitable contract, or remuneration is essentially required because it saves one another. That is, initially the insurance company is saving the insured person, and in the second case, the reinsurance company is saving the insurance company. So the saving of each another or one another contract is being undertaken in terms of a reinsurance contract, and hence there is an involvement of profit in this particular transaction. The rate of return. Now here at this stage, the rate of return is always equal, estimated or pre-decided for each and every individual. In terms of an insurance contract, the rate of return is always pre-decided, and accordingly, based on those return that has been decided, the insurance company pays a certain amount of money to the insured person. In case of a reinsurance contract, the reinsurance company will make a certain payment to the primary insurance company. But in this case, the amount of profit or the rate of return is not decided. Depending on the amount of loss, depending on the amount of policy, depending on the amount of premium, the amount of profit or the rate of return is been decided, and then accordingly the profit percentage or sharing is been done between the parties. So at initial stage, there is a fixed percentage between the insured person and the insurance company, whereas in the second stage, there is no fixed percentage between the insurance company and the reinsurance company. At every stage, what are we looking for? We are always looking for minimum suffering to all the parties, wherein in the case of an insured person or the insurance company or the reinsurance company, however, the profit should be maximized and the risk of loss should be minimized. So, for minimum suffering of loss at every stage, the insurance contract or reinsurance contract is being signed between the parties. Now, at every stage here, what do we have? We have a futuristic approach. That is, we are always looking into future, that how the risk of loss or the amount that is going to be suffered will be minimized, and each and every participant or each and every member of the reinsurance contract is been benefited. So, revenue generation, profit generation, and sharing of risk or sharing of loss is been mitigated, or it is been saved at every stage or every point of time. So for this particular concern, the risk of loss is needed to be shared, and reinsurance contract is being undertaken by the various reinsurance companies. Now let's look at the various reinsurance contract and how it profits the various participants. The first benefit that a particular reinsurance contract is that generates is the transferring of risk, wherein the risk is been transferred from one person to another person or one company to another company. That is, transferring of risk from the insured person to the insurance company, and gradually from insurance company to the reinsurance company. Smoothing of income. The income that has been generated from the reinsurance contract is always smoothened, wherein in reverse, the reinsurance company pays the premium or pays the amount of compensation or loss to the insurance company, and the reinsurance company again pays the return or amount of risk of loss to the primary insured, that is the insured person. So in this way, the income level or the returns or the profits are also being shared, or they have been smoothened. Surplus relief from loss. So whatever loss that has been incurred or suffered by the parties that have been involved, it is always shared between the parties. So the parties to the insurance contract or the are the insured person, the reinsurance person, and ultimately the insurance person. So in this way, the surplus relief from loss is always being shared between the parties, and accordingly, it saves or it benefits all the participants of the reinsurance contract. The solvency margin ratio. Solvency margin ratio is a ratio wherein above beyond this particular limit, the profit or loss cannot be shared. So in case of an reinsurance contract, the solvency margin ratio can be pre-decided at a certain percentage. Take an example wherein the solvency margin ratio can be set at either 5%, 10%, 12%, 15%, depending on the mutual agreement between the parties. Now, the parties involved in this particular contract is the insurance company and the reinsurance company. So both these particular parties can mutually decide a certain amount of contract or a certain amount of solvency margin ratio, and accordingly, the profit can be shared between those parties. Arbitrage to save either profit or loss. So here in this case, what happened? There is always an arbitrage or a certain situation wherein either a profit may arise or either a loss may arise. And at every stage, whenever there is a certain terms and conditions that have been laid by the insurance company or by the reinsurance company, the arbitrage or a situation of sharing the profit between the parties is always been assumed, wherein the arbitrage is a situation wherein whatever, whether there is a profit or whether there is a loss, both the things will be shared by the respective companies over a period of time. Reinsurer's skill and expertise. So whenever there is a skill and expertise that is into existence, the reinsurer person or the reinsurance company will apply its skill and expertise, and accordingly they will try to see that how the risk of loss is being minimized. So various measures are needed to be undertaken in order to see that the risk of loss is always minimized, and accordingly there is no burden or there is no more loss to be suffered either by the reinsurance company or either by the insurance company. Manageable and controlled profitable portfolio. The portfolio that we have to make between the insured person and the insurance company must always be manageable and it must always be controlled. That is, whatever risk of loss that we are going to suffer or the company is going to suffer, always it should be in a controlled manner. So various measures, preventive actions should be taken to see that the loss that is being suffered either to the goods, to the services, or to the life of a person or to the health of the person is always minimized, and accordingly there is no burden on either one of the party to the contract. The burden may either be on the insured person or the insurance company or to the reinsurance company. Managing the capital and cost. So the managing of capital is of essential and utmost importance, wherein the capital is moving from one level to another level. In the first phase, the capital is moving from the insured person to the insurance company and then to the reinsurance company. But when the claim is been finalized and it has been settled after the payment of premium, the capital is moving in a reverse direction. That is, the reinsurance company pays the capital to the, that is the amount of compensation to the insurance company, and the insurance company pays the amount of capital or reimbursement or the compensation to the insured person. So here in this case, management of capital in terms of amount, quantity, quality, and so on is essentially required. Reinsurance and its capital creation. Always, the reinsurance company creates the capital for its own business as well as creates the capital for the insurance company. So in this way, the profit is always being created in the from the amount of profit that is being generated, from the amount of profit that is being paid, or the amount of premium that is being shared between the insurance company and the insured person. So in this way, the amount of profit or remuneration is been created and it is been shared between the different parties. Now let's look at the scenario or see how the reinsurance works. In case of an reinsurance contract, we have along three parties. Initially, we have the insurance policy holder, then we have the reinsurance company, and lastly, we have the reinsurance company. So, the insurance policy holder pays a certain sum of money in part of a premium to the insurance company. And for this particular payment, we have various middlemen, and those particular middlemen are known as either the agents or the brokers. And when the contract has been signed between an insurance company and the reinsurance company, there is a certain intermediary which is also called as a reinsurance intermediary who collects the premium on behalf of the insurance company and pays it to the reinsurance company. So in this particular case, the risk is been transferred, or the loss of supposing the loss is been moved from one place to another place, and all the parties are trying to cover the risk of loss which is going to be suffered over a period of time. So in this case, the reinsurance contract is always a profitable contract wherein the sharing of profit or sharing of loss is being undertaken by the different parties. So now let's summarize what we have learned in this particular session. In this session, we have learned what do we mean by reinsurance and what is the definition and meaning of reinsurance. Next thing, we have understood or we have learned with the importance as to profit as a need for a particular business or an insurance contract. And lastly, we have also seen with how a profit is being earned in a reinsurance contract. That is, the profit that has been created or generated between the insured person and the insurance company and the insurance company and the reinsurance company. Thank you for your patience listening. Thank you.